You want me to tell you the number one reason why people are getting denied for auto loans ever since COVID? Here, I'm going to tell you why. So let me tell you how auto loans work. When you take out an auto loan, or really any loan, they're going to look at things like your debt to income, your payment to income, and the loan to value. What is the loan that you're taking out compared to the value of the collateral? Here's a common misconception. People think because they make enough money to take out that loan, let's say you make $4,000 a month, that you can afford, in this case, if 20% of that would be $800. The thing is when you go to take out a loan, the people at the bank are looking at your credit report, not just your credit score, and they're going to take into account your monthly obligations. So they're going to look at your credit card, get your personal loans, get your rent and your mortgage, and they're going to say your income, $4,000, minus your current obligations leaves you only with $2,000 remaining. So of that $2,000 remaining, you can take about 20% of that out for an auto loan. That's going to leave you with a $400 to $500 a month payment, right? Well, they also go ahead and they look at a thing called a loan to value. And for the purposes of this video, this is going to be the big one. Why is that? Because if you're taking out an auto loan today and you go to take out a $40,000 car loan or a $30,000 car loan, the payments are going to be $600 or $800. So if you have to get a payment that is $400 to $500 a month, that means you'd have to be on a $20,000 to $25,000 auto loan. The problem is that everybody who bought a car during COVID bought at the peak of the prices. And so because of that, they come in to trade it in and they have a lot of negative equity. So when you try to roll over negative equity of, let's say, $5,000 that rolls on top of that other $25,000 auto loan, well, $5,000 would be 25% more. So that would put you at 125 to 130% loan to value, which then requires you to put down $3,000, $4,000, $5,000, $6,000 to get under the ratios that the banks have in order to take out that loan. So if you don't have that money to pay up front out of pocket, well, then you have to be on a more expensive vehicle, because to roll over $5,000, you would then have to be in a $40,000, $50,000 vehicle, which would then be an $800 to $1,000 payment oftentimes. And so because of that, now you're limited based on your income for your payments, where even if you were okay taking out that kind of payment because of your current obligations, they're going to say no. Fortunately, at Dennis Dillon, we do have some of the best finance managers, sales managers, floor managers across the board, and we have programs designed to get people approved regardless of that happening. So if you do like the idea of this, come visit us.